Welcome to your deep dive. Today we're diving into quite a bit of material, actually. We've got the Q2 FY26 financials, the press releases, and the full analyst call transcript for HDB Financial Services Limited at HDBFS.
Yeah, quite a stack. And our goal for you today is pretty straightforward.
Yeah.
You want to synthesize how this really large NBFC navigated what was, frankly, a seasonally slow quarter.
Right.
We'll focus on what drove that pretty impressive income growth, but also crucially why a very specific localized weather event caused a, let's say, challenging bump in their asset quality.
Okay.
We'll stick to the numbers and what management said about the, near-term outlook.
Okay, that sounds like a core tension right there. Let's start with the big picture financials then, because the underlying business seems, well, incredibly healthy on the surface.
It does.
HDBFS reported gross loans hitting 1,011,409 crores. That's decent growth, 13.0% year on year.
Yep, solid.
But here's where it gets, I think, really interesting. Net interest income, NII. That surged nearly 20%, 19.6% year on year, hitting 2,192 crores. And when NII growth jumps that much faster than the loan book, that's usually a very positive sign, isn't it?
That's the key thing to notice right off the bat. It signals, really effective margin management, pricing power maybe. Despite all the headwinds, rising rates, which often squeeze margins, their net interest margin actually went up sequentially.
It did.
Yeah, it hit 7.9% in Q2. Now, put that in perspective.
Yeah.
That's up from 7.7% the quarter before and 7.5% a year ago. For an NBFC this size, getting close to 8% IM, that shows some real skill on the liability side.
So they're basically earning more on their loans and paying relatively less for their funding. That's step one for strength.
Exactly.
Step two is always deficiency, right? We always look at that cost-to-income ratio.
Absolutely. And this is another area where, honestly, the story is just really positive.
Okay.
The cost-to-income for the lending business dropped sharply, came in at 40.7% in Q2.
Wow, 40.7.
Yeah, down from 42.7% just the quarter before. And the same last year. Think about that. That's a 200 basis point drop.
That's significant.
It really is. It shows, tight operation control, scalability. They're getting more profit from each rupee of revenue, even when growth was, well, moderate.
Which brings us right to the central puzzle here. If you've got a growing loan book, fantastic margins, great efficiency, the profit should be soaring, shouldn't it?
Logically, yes.
Yet, profit after tax, PAT, was 581 crores. That's only up, 2.4% from Q1, and actually down slightly, 1.6% year on year.
Precisely.
So strong top line, kind of flat bottom line.
Yeah.
What was the big drag? What ate up all that NII growth and efficiency gain?
That is the key question the whole report turns on, and the answer is pretty stark. Asset quality.
Huh.
Loan losses and provisions for this quarter alone.
No.
They came in at 748 crores.
748.
Now, compare that to the same quarter last year, Q2 FY25, it was 431 crores.
Okay, so that's a 73.6% increase in provisions.
Exactly, a massive spike. That's the huge counterweight that basically neutralized all the good news from NII and efficiency.
Yeah. A 73% jump isn't just, a minor issue. That sounds like something significant happened, and naturally that flows right into the bad loan numbers.
It does. Gross Stage 3 assets, that's the industry term for NPAs, bad loans, they ticked up to 2.81%.
Up from
2.56% last quarter. So not a huge jump in the percentage itself, but the underlying provision number tells the story of the pressure.
And that immediately makes you ask, is this across the board? Is their overall credit quality starting to fray, or is this isolated?
That's the critical distinction, isn't it? If it's systemic, that's a much bigger worry. But the management commentary on the analyst call, they were very, very specific, laser-focused, really.
On one particular area.
Yes. They pointed directly at the commercial vehicle financing segment, the CV loans. Now, that's part of their asset finance vertical, and it's big, 38% of the total loan book.
Okay, so big enough to definitely move the overall numbers.
Absolutely. And they detailed two very specific sort of acute factors driving the stress. Importantly, they framed these as non-structural issues impacting customer cash flow just in Q2.
Okay, two factors. And the first one involves the weather, which sounds unusual for a financial report.
It does, but it was apparently quite severe. They called it monsoon accentuation.
Monsoon accentuation. Okay.
Yeah. They said unusually high rainfall and, crucially, flash floods in specific areas, mainly North and East India, caused major problems for vehicle deployment. Trucks couldn't run.
Just idling.
Significant idling. Management estimated it was much higher than usual for the season. In some markets, they said idling rates hit, get this, 30 to 35%.
Wait, stop. A third of a commercial fleet in some regions just parked, unable to operate, unable to earn revenue.
That's what they reported.
I mean, that's not just a slowdown for the truck owner, that's a catastrophe.
They come
No revenue means no ability to pay the loan. Right.
Exactly. That directly fuels that huge jump in provisions we saw.
Yeah.
You look at 2.81% gross stage 3, that's abstract.
Right.
But when you picture a truck stuck because of floods for weeks, it suddenly makes sense why payments stopped. It wasn't necessarily a bad loan decision years ago. It was an immediate, severe operating problem.
Okay, so factor one, extreme weather hitting operations hard.
Yeah.
What was the second factor that compounded things in Q2?
The second was policy uncertainty, specifically around GST rates.
Ah, the anticipated rate cuts.
Right. There was talk of GST rationalization, potential cuts for vehicles. So what happens? Customers delay buying new trucks.
They wait for the lower price.
Exactly. So demand deferred. This put extra pressure on existing operators, too, because overall transport activity might have slowed down a bit in anticipation. Lower transaction volumes mean less cash flow for existing borrowers.
Okay, so let me connect these. The fantastic efficiency gains the company made were essentially wiped out by these two specific, localized hits to the CV segment. Bad weather stopping trucks and expected tax cuts delaying purchases.
That seems to be the narrative management presented, yes. It wasn't systemic across the whole book.
And they did mention, didn't they, that stress in their other big segment, the MSME loans part of enterprise lending that had stabilized?
Yes, they made a point of saying that, which supports their argument that the CV stress was the main driver, the outlier.
So this high credit cost, 2.7% of loans, this quarter to see that as temporary, elevated.
That's exactly their message. They're aiming to get that back down to their medium-term target range, which they stated is 2.0% to 2.2%.
Okay.
So that gap from 2.7% down to, say, 2.1%, that's basically the quantified impact of the monsoon and the GST effect in Q2.
Right. Let's pivot then to the segments in the outlook. The portfolio is nicely balanced. Enterprise lending, 38%. Asset finance, also 38%. And consumer finance at 24%.
Okay, starting with enterprise lending. Growth was moderate there in Q2, but they highlighted really good traction in one specific area, gold loans.
Ah, gold. Always popular.
Yeah, and apparently helped by some recent regulatory changes. Plus, the high gold price itself makes it good collateral. Importantly, they also said they're still being cautious on unsecured business loans.
Right, they'd flagged potential stress there before.
They did, but they expect to return to growth there once these broader asset quality pressures ease up a bit.
Okay. And consumer finance. That's the other 24%. How did that fare with people waiting for GST cuts?
Pretty similar story, actually. Moderate growth in Q2, again, largely due to that demand deferment, people holding off buying two-wheelers, consumer durables.
Waiting for the price drop.
Exactly. But, and this is key for the outlook, management gave a very positive signal for Q3, for the current quarter. They said they're already seeing, and I quote, good movement in retail offtake in the first few days of October.
So the pent-up demand is starting to release now that the uncertainty is over.
That's the implication, which leads directly into the festive season boost.
Right. The timing is good. So what's the overall strategy now to leverage this turn in momentum?
They're counting on a few things coming together. One, obviously, the festive season itself driving spending.
Standard seasonal uplift.
Standard uplift. Two, some positive macro factors. Inflation easing a bit, potentially better farm incomes from the Kharif harvest, which helps their rural base.
Okay.
And three, critically, those GST rate cuts for CVs actually happened. That reduces the cost of ownership, directly addressing one of the big Q2 pain points.
So the monsoon impact fades seasonally, and the policy headwind is now a tailwind. Makes sense.
Yeah.
They also spent some time on a niche product, didn't they? Relationship personal loans. RPLs.
They did, and it sounds quite important strategically, even if it's small overall. It's a cross-sell product, only offered to existing customers with a good track record.
Like a loyalty reward.
Sort of, yeah. Build stickiness. It's currently about 8% of the loan book, but here's the kicker. Management said it's grown at a CAGR, compound annual growth rate, of over 40% for the last 4 or 5 years.
Wow, 40% CAGR.
Yeah.
In a select existing customer segment.
Yeah, that's incredibly fast, high-quality growth. It shows they can really leverage that existing customer base, which is huge, 21 million customers now. It's a valuable, predictable business.
Definitely. So with that kind of internal engine, plus the expected market recovery, what's the big picture goal? Where do they see growth going? long term?
They put out a fairly ambitious target. They're projecting 18% to 20% CHR book growth over the medium term.
18 to 20%.
Yeah, over the next, say, 3 to 5 years. They believe they can do it by leveraging that operational efficiency we talked about, their strong capital, that diversified portfolio, and that huge customer franchise.
Okay, so summing up this deep dive,
Hmm.
we saw a company with really strong fundamentals, didn't we? Sharp efficiency gains, that 40.7% cost to income is impressive. Great margin management, NIM at 7.9%.
Absolutely. Core health looks good.
But the whole Q2 story got overshadowed by that very specific, very localized challenge. The CV stress,
Yeah.
driven by, well, extreme monsoon conditions and that temporary GST demand pause.
And their ability to weather that storm, pardon the pun, is backed by strong capital. Their total CAR is still very healthy at 21.82%, well above requirements. Oh, and they declared an interim dividend,
Right.
2.0 per share. So the focus now is clearly ride the festive wave, benefit from the GST cuts finally landing, and get those credit costs back down towards that 2.0, 2.2% target range.
Thinking about that severe regional monsoon impact, especially on CV financing, it does raise a broader question, doesn't it? Particularly as these kinds of extreme localized weather events seem to be getting more frequent. What specific changes might you need to bake into your long-term risk models, your geographic assessments, when climate change can directly disrupt customer cash flows and the actual deployment of the assets you've financed? How do you price for risk when a flood can literally stop a truck from earning revenue for weeks? Something to think about as you track HDBFS's Q3 recovery.